Great. So welcome to our free session, courtesy of RCM Online College. So those who are joining this particular class, or those who have joined this class, it should be someone who is taking fundamentals of management accounting, someone who is taking management accounting, someone who will be sitting for advanced management accounting, and of course, someone will be taking the exit paper, that is business data analytics. Good. So if you look at this particular question, you are going to deal with a concept under budgetary control, specifically flexed budget. Let's have a look at this particular question and see what is presented here. So we are having a question here that is Folico Manufacturing Limited produces premium jewelry. The company prepares its budget for the year based on the estimated production and sales of its products. The following budget was prepared for product Malkia for the current month based on the production of 1,250 units. However, due to unexpected demand, the company ended up producing 1,500 units. So this is a situation whereby we have difference in actual production and the budgeted production. So for us to be able to match these two and be able to identify the differences or the variances, then we must do what we call flexing of the budget. So let's see what is given. So we have below are the budgeted and actual figures. So we have budgeted figures when 1,250 units were to be produced. So these are the costs or expenses incurred. Then if you look at the actual activity or actual production, then we now have different sets of expenses. So under additional information, what they say, the selling price of product Malkia is 230 shillings per unit. Where necessary, use the per unit variable cost derived from the budgeted figures. Folico Manufacturing Limited has a sales contract to deliver 850 units of product Malkia every month. Folico Manufacturing Limited sales averages 80% of the units produced in any month, right? So their sales is an average of 80% of the units produced. What does it tell us? It means not all units produced are actually sold during that particular period. This percentage is inclusive of the sales contract units. So they have a contract of delivering 850 units every month. So it means the 80% of the total sales includes the 850 units that are actually supposed to be sold under the contract. Then the corporation tax rate is 30% payable on realized profit. What are we required to prepare here? So required, number one, prepare a flexible budget for 1,500 units. Determine the total flexible budget cost for 1,500 units. At 1,500 units, compare the flexible budget cost with total actual costs. Using a logical function, identify the variances as either adverse or favorable. Good. So let's see what we are having here. Number one, we are told to prepare a flexible budget for 1,500 units, a flexed budget for 1,500 units. So if you look at what we are having here, if you look at the data that is given to us here, these costs represent the budgeted production of 1,250. Then we have now actual production. So what we need to determine here is we cannot compare budgeted production and actual production if we have difference in units. So our units must be matched to be equal. We cannot have difference in units and then we compare the cost. That's, I'm trying to say, we cannot say that we are going to compare 1,250 units and 1,500 units. We must make these units to be equal. We must adjust them to be equal. So that process of adjusting our actual production and budgeted production is what we call flexing of budget. And of course, the result is what we call the flexed budget. So for us to be able to come up with a flexed budget, number one, we need to identify what we call flexing ratio. We need to identify what we call flexing ratio. So let's see, how will you be able to come up with a flexing ratio? We can do our workings here. Let me have this in place. Let's just adjust it here. Let's adjust it there. Good. So now, for us to be able to flex this particular budget, budgeted production is 1,250. Actual production is 1,500. Is 1,500. So how do we normally calculate flexing ratio? That is FR in bracket, flexing ratio. Flexing ratio. So our first step is to come up with a flexing ratio. Flexing ratio is equal to actual production divided by budgeted production. Actual production divided by budgeted production. So with that particular formula, can someone give us the flexing ratio? Can someone give us the flexing ratio? Flexing ratio, can someone give us the flexing ratio? Yes, what are you getting? So budgeted production, do we have the two? Yes, we have actual. We have actual production, then we have budgeted production. So our actual production, 1,500 units. Budgeted production, 1,250 units. So let's use these figures here for us to be able to get the flexing ratio. So flexing ratio is 1.2 to 1.2. Good. So let's do it together. So our flexing ratio here, is equal. You can put it here. Our flexing ratio is equal to actual production divided by budgeted production. So we are getting 1.2. That is the flexing ratio. Good. Another thing that we need to consider, this flexing ratio will only affect the variable components. The fixed component will not be flexed. The fixed costs are normally constant. So whatever will be affecting our total cost or the variable cost is only the variable component. That is, direct material will depend on the units of output. Direct labor cost will depend on the cost or units of output, and therefore it is only the variable components that are normally affected by the flexing ratio. So let me autofill it here. Let's have here. So do we need flexing ratio for the direct material? Confirm there. Do we really need flexing ratio for direct material? Are we going to apply it here for the direct material? Yes. How about direct labor? Remember, direct labor is dependent on the units of output. So we are going to have it there. Let me just look it here. Good. How about variable manufacturing overheads? Do we need it there? Variable manufacturing overheads? Yes. How about fixed manufacturing overhead? No, we are not going to flex it because the fixed manufacturing overheads does not depend on the units of output. How about variable sales and administrative expenses? How about variable sales and admin expenses? We need it there. Good. About fixed sales and administration expenses. Fixed sales and administration expenses. We don't need it there, right? Good. So we've been able to identify the flexing ratio. We've been able to identify the flexing ratio. So all this is being done. All this is being done when we are dealing with how many units? We are dealing with 1,250. 1,250 units, right? So this is the initial budget. This is the initial budget. So once we have the flexing ratio here in this particular column, we should be able to go and get what we call flexed budget. So we should be having what we call flexed, budget. So our flexed budget here, we are adjusting these units to 15 to 1,500. We must have the flexed budget and the units should be equivalent to actual production for us to be able to do what? For us to be able to make a comparison. So the first thing we are supposed to do is to get the flexing ratio. Once you're able to get the flexing ratio, then, so here we have the flexed. You have the flexed budget, right? So here we have 1,500 units. So can we now get the flexed material cost? The flexed material cost. So the flexed budget is arrived at by taking the initial budget multiplied by the flexing ratio. So let's have that in place. Now that we are using Excel, it is very simple. We just need to take that and multiply by the flexing ratio. So by doing that, we'll be having our cost all the way to the last part. And we have said the fixed components are not flexed. They are going to be constant. So I just need to refer to the fixed amount. We just need to transfer the fixed amounts to this particular section. So that's what you are required. That's what you are required to do. That's what you are required to. Let's see what you are required to do. Part 1. So prepare a flexible budget for 1,500 units. That's what we've actually done here. We've been able to come up with a flexed budget for 1,500 units. So with that, we can actually get the total. We can actually get the total cost. So the total manufacturing cost is equivalent to summation of all these expenses. So let's add everything here in this particular column. Let's add everything here. So when you add everything, what are you getting? Are you getting 239,000 from your side? 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 Please confirm. Confirm if you're getting the same amount here. Confirm if you're getting the same amount. Confirm if you're able to get the same amount. Are we getting the same thing? Are we getting the same thing? Great. So that's what you are required to do under flexed or flexible budget. So let's go to part B and see what they wanted us to do. Let's go to part B of the question. So part B, we are being told, determine the total flexible budgeted costs for 1,500 units. Determine the total flexible budgeted cost for 1,500 units. So that's what we've been able to get here. The total cost is this one here. So you're required to give us 239,000 as the summary of these individual expenses. Let's see part C. Let's see part C. What do they want us to do in part C of this particular question? So at 1,500 units, compare the flexible budgeted cost with the total actual cost using a logical function, comma, identify the variances as either adverse or favorable. Good. So let's get to this point. Now we can compare our budget. we can actually compare budgeted output and actual output. Initially, we were not able to compare that because we are having a budget of 1,250 units here, and actual production was 1,500. So we cannot compare 1,250 and 1,500. No, we need to adjust the initial budget to be equivalent to actual production in terms of quantity. That's why we've been able to adjust it from 1,250 to 1,500 units. And the result is what we call flexed or flexible budget. So we can now go ahead and compare this flexible budget with the actual production or actual results. In reference to the data that was given to us, do we have actual results? Yes. We are told actual results for 1,500 units is actually available down here. So what we need to do is to take these costs and transfer them. We need to take these costs here and transfer them to this particular section. So actual results. That's our actual results. So we can now comfortably compare flexed budget of 1,500 units and actual results, actual results. So the flexed budget of 1,500 units can be compared with equivalent units of 1,500, right? So at this particular point, are we able to move forward and come up with the variances? When you compare flexed budget and actual results, you'll be getting the variances here. So let's have variances. Let's have variances here. Let's have variances. We are dealing with expenses. So if you plan to spend, if as per your budget, you plan to spend 32,400, you ended up spending 32,000. Is it a good variance or a bad variance? Is it a favorable variance? You plan to spend 32,400, you ended up spending only 32,000 shillings. So is it a favorable or adverse variance? Is it a favorable or adverse variance? It is a favorable variance, right? Because you've spent less than what was actually planned. So we can have it this way. We can say if budget or budgeted amount is greater than actual results for the expenses, then it is actually favorable. We get a positive. If it is the reverse, then you are having adverse variance. We'll be having adverse variance. We'll be having adverse variance. Good. So that's the variances. But now look at what they have introduced. Remember this question here. Look at what they have introduced. We've been able to do everything as per. We've been able to do everything. So the first thing, at 1,500 units, compare the flexible budgeted cost with the total actual cost. That we've been able to do perfectly. Then they are telling us, using a logical function, identify the variances as either adverse or favorable. So they are now telling us that, you know what, those ninjas who joined Advanced Excel should be able to handle this particular section. Should be able to handle this particular section. So we want to comment on the nature of variance. We want to comment on the nature of variances, right? So they're telling us, you know what, using your knowledge that you learned in Advanced Excel, please tell us whether this one is variable or, I mean, favorable or adverse. So you come here and tell us equal to if, right? We are now applying Excel. That's the logical function they were referring to. So if our variance here is greater than, not equal to 0. If our our variance here is greater than 0, then what are we going to say? If our variance is greater than 0, then it means it is a favorable variance, right? So if it is greater than 0, comma, we'll come here and indicate the word favorable. Can you indicate the word favorable? Get the word favorable, right? Good, comma. Now that we have the other condition where it is negative, so we come here and say the second condition, we say if our variance is less than 0, if our variance is less than 0, then we are going to refer to it as adverse variance. Adverse variance. Good. If it is not meeting any of those two conditions, then it means there is no variance, right? If it is not meeting any of those two conditions, that is, it is not greater than 0, it is not less than 0. It means it is equal to 0. What was budgeted is equal to what was actually incurred, and therefore we don't have any variance. So if it is not equal to any of these two, then we now say let it be an empty cell. We don't want to have any comment there. We don't want to have any comment there. So let's have it here. Don't want to have any comment there. So by doing that, we can now see the variances that are here. So we now say our variance here of 400 positive 400 is a favorable variance because we spent less compared to what was actually budgeted for. The same to this one here. When I come now to number 3, we now come to number 3, we are talking about variable manufacturing overheads. You plan to spend 15,000, you ended up spending 18,000. You've spent more than what was actually budgeted for, and that's what gave us a negative variance. That negative variance is referred to as adverse. Then this condition here, for the fixed manufacturing overheads, the budget was 75,000. Actual results, 75,000 was actually incurred. So we don't have any variance here. What was budgeted is what was actually spent. So the variance is actually not there. Good. Now you can be told to give us now or reconcile. You can be told to reconcile these particular statements. That is the budgeted activity and the actual result. So you now give us here total manufacturing cost, right? We have, so for you to reconcile this, we have budgeted, total manufacturing cost. So the budgeted total manufacturing cost, is equal to the budgeted total manufacturing cost is equal to this amount here. We have 239, 235, 239. Flex budget is the total cost. Then, then we have the variance. We have the variance now. So when you now bring in the cumulative variance, we should be able to arrive at what we call the actual results. We should be able to arrive at the actual. We should be able to arrive at the actual results. So that's how we normally deal with this. But what you are required to do as per this particular question is to give us the flexed budget, which we've been able to do, compare it with actual results so that you get the variances, which again we've been able to deal with. And then from that point, you give us the nature of the variances. They said that, you know what, you should not just indicate favorable, adverse. No, use a logical function. And that logical function which we've been able to apply here is if function. So those who are sitting for this paper may be sitting for the paper-based exams, and they were told to handle this particular question without this logical function, the if function. Even if your answer is correct here, you are supposed to get a 0 for the nature of variances here. Under comment here, you are supposed to apply the logical function. So without the logical function, then it means you are supposed to get a 0 for this particular last column. Good. So are we together up to that point? Are we together up to that point before we proceed to the next section? Are we together up to that point? Are we together up to that point? Are we together up to that point? Great. Let's move to the next part of the question and see what you are required to do. Let's move to the next part of this question. So after dealing with part C, you are now being told, prepare an income statement for manufacturing levels of 1,000, 2,000, and 2,500 units of product Malkia. Good. Now, what we need to consider up here before we even get to these production levels is, are we able to get the production cost per unit? Right? Are we able to get the production cost per unit? The production cost per unit that we're going to deal with here again is dependent on two factors. We must consider the method that this particular company is using to arrive at the production or cost per unit of output. So we have two methods that a company can apply to get the cost of each unit produced. Number one, they can be applying what we call marginal costing method. They can be applying what we call marginal costing method. Marginal costing method. They can be applying method number two, which is called absorption. Absorption costing method. So under marginal costing method, we need to get direct material. We need to get direct material. We need to get direct labor. We need to get direct labor. We need to get variable production overheads. Then for the absorption costing method, we need to get these three items, then we add fixed production overhead, fixed, so that we get fixed. So for us to get cost per unit of output under marginal costing method, we only take direct material, direct labor, and variable production overhead. Under absorption costing method, we need to take marginal cost plus fixed production overhead so that we get cost per unit of output. So in this particular question, in reference to this particular question, were we given anything that relates to the costing method? Were we given anything that relates to costing method? Which method are they using to get cost per unit of output? Were we given that? Were we given that in this particular question? Let's look at it and see. Were we given the costing method? And additional information, do we have anything referring to the costing method to be used? So this was this one here, it was an open question. It was an open question where those who indicated in their workings that, you know what, not that we have assumed, or I have assume the company uses, right? So if you take marginal costing as the assumption and then you do all the workings correctly, you are to get your full marks. If you assumed that the company uses absorption costing method and you did your workings correctly, you are to get your full marks under this particular question. Good. So for us to be able to complete the remaining parts, I would like to invite you to join our online classes for the September intake. I would like to join our September intake classes, and these are the packages that are available for you before we complete the remaining part. So number one, we have those who are retaking. These units. You attempted it last semester or in the last sitting, but you did not manage to succeed. Now, we are going to give you an interesting discount here. So if you are taking CPA, unit, you're retaking any CFA unit, you are retaking any ATD or any CAMS unit. If you are taking CPA, CFA, ATD, or CAMS unit, then you'll be charged this amount here. So you'll be charged 3,800 upon providing your results. So the retakes here again, we have two categories. The retakes here, we have the category of, that's RCM students, and those who are going to join RCM for the first time. So those who want to join RCM for the first time and they are retaking this unit, will now be given again this offer, but now the fee they're supposed to pay. So that's the benefit of actually being a student at RCM. So those who have been there will be having 3,800 as a discounted amount. Those who are joining for the first time will be having 4,000 as a retake fee. Good. So those who are going to attempt about BDA. So BDA, those who are retaking and they were at RCM will be charged 4,500 for the entire semester. Then those who are joining RCM for the first time and they are retaking this BDA, they'll be charged 5,500. Those who are doing these papers for the first time, so we have first attempt. So first attempt, those who are doing it for the first time, you'll be able to enjoy these services. Here. So here, there's no consideration of being RCM or non-RCM student. If you're taking them for the first time, so here you'll be charged 4,800. You'll be charged 4,800. You'll be charged 4,800. Then for the BDS students, you'll have to pay 9,000 for the entire semester, right? So this is for both RCM students and non-RCM students, right? Good. Now, any of the packages here, if you fall under this first category of retakes, or you fall under the second category of first attempt, then these are the items you're going to enjoy. Number one, you'll be able to join live Zoom classes. You'll be able to enjoy videos, free revision videos, for what was covered in last semester under the same topic, under the same unit. So you can actually read ahead of the teacher by getting what was covered last semester, and then you do your reference. And of course, you'll also be able to access what is being done in the current semester, both in live class and also even recorded classes. So all this will be provided to you once you pay any of the amounts indicated up here. So for the payment details, so just do payments to our pay bills, 6242,839. Account number, you indicate the unit name. So if you're taking BDA, just indicate BDA as the unit name. If you are taking FM, indicate FM as the unit name. If you are taking more than one unit, just list all the units there under account name, then you do your payment. Another advantage, it might not be possible for you to afford this 9,000 at once. It might not be possible for you to afford this 4,800 shillings at once. You can pay at least half of the total fee today and clear the balance within 30 days. And clear the balance within 30 days, but you get, if you wait until you get the full amount, others will be learning. And of course, it will take you a lot of time to catch up with the rest. So to avoid that, just do half of the total fee and join the classes immediately. Good. So those are the payment details and of course the packages. For any inquiry beyond that, just reach out to 07 93 555 000, or you can also reach out to 07 19 525 for any other inquiry. For you to be able to purchase revision kits and study text, you can also reach out to 07 98 94 99 99. So you can also reach out to this number if you want any inquiry with regards to the study text and revision kits. Great. Good. So let's have that in place. So are we together up to that point? So those who are taking advanced management accounting, you can now handle a question. You can now handle a similar question from this particular sitting. You can now handle a similar question under the same concept from this sitting. You can now handle a similar question, but a different question under the same concept. So get to this part here, get to this part. Get to this part. Get to this part here. So the advanced management accounting students, so you can go to AMA, December 2022, question number 1B. Question number 1B, you should be able to handle that particular question. Then someone who is doing CPA intermediate level, that is management accounting, you can go to December. You can go to December 2023, question number 4B. Question number 4B. You'll be able to handle another question that covers the same concept that we've actually tackled here. So that's what will enable you to do revision with regards to the concept that we've learned today. Great. So that is it. That is it, unless there's another thing that we need to take care of. So that marks the end of our today's session. And of course, I welcome all of you to our September semester. Thanks for your time and have a great afternoon.